Imagine turning $10,000 into nearly $80,000 by holding just one ticker. Since its inception, VFV, the largest ETF in Canada, has returned a staggering 684%. Is it still a viable core holding for you in 2026? I'm going to get under the hood. What's in it, how it behaves, what to love, and what to watch out for. This is a deep dive you cannot afford to miss. Let's do this! Before we jump into the performance of VFV, if you're new to the channel, welcome. I'm Mr. Financial, and I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on social media hype. If this is your vibe, subscribe. Now here's a quick overview for some context. What exactly is VFV? It is the Vanguard S&P 500 Index ETF. This is a low-cost and passive way to own 500 of the largest U.S. companies that make up about 80% of the total U.S. market capitalization in Canadian dollars and traded on the TSX. VFV was launched in November of 2012. It has the most total assets of any ETF in Canada at $27.8 billion, with a good amount of daily trading volume and a very small bid-ask spread. It has quarterly distributions, with its latest at 42 cents. VFV has a management expense ratio of 0.09% and a trailing 12-month yield of 1%. It has a risk rating of medium and is unhedged, meaning it is subject to currency fluctuations between CAD and USD and vice versa. This ETF is tracking the world's biggest and most popular index. The S&P 500 is considered by many the hallmark of indices in the world, and for good reason. More on that later. You can find all of this information right on the main page of VFV. There you have quick access to all the documents you need so you can make an informed decision. Now that 0.09% fee sounds great on paper, but low fees don't matter if the fund isn't actually delivering what you bought it for. So, did VFV actually capture the massive US bull run of the last decade? The most recent data from Vanguard shows that since inception, VFV has returned 16.6% annually. It has done very well the last 10 years too at 14.6% and the last 5, 14%. This is where it gets a little crazy. The last 3 years, 19.1%. Lately, it's suffering, down 3.2% year to date. Of course, this number can shift a lot, even month to month. That's what volatile assets do, and why it's important to understand performance in the proper context. Just as an example, going back just 1 month, the compound annual return since inception jumps to 17%. And jumping just 1 more month, it increased to 17.2%. And in October of last year, 17.6%. That's a change of 1% in just the last 6 months. And all those 5, 3, and 1 year performances look so juicy and so sweet to the bank account. I'm showing this to help you see how timing impacts investment returns. The key is long-term holding. Here are the cumulative returns. Since inception, 684%. Lovely. Those other holding periods are amazing too. A 5-year return of 92% is not the norm and a real blessing for those that have captured that gain. Now let's break down the data, starting with the annual total returns and go more granular from there. The worst year since inception was 2022 at negative 12.6% by market price. The best was 2013 at 41%. In part due to what happened to the US to CAD. It looks smooth until we zoom in a bit more. Look at these quarterly total returns. Do you notice some double-digit losses and also some big double-digit gains? It's looking a lot less smooth. And remember, this has been during a predominant bull market. This monthly return chart tells us volumes about the performance. 48 of the 160 months were red. That's 30% of the time, with only 1 month that was completely flat. There was not 1 year that didn't have a negative month, even that 41% year in 2013. That's how random returns can be, and yet average out to a compound annual return of 16.6% currently. Now, we can only imagine if we really zoomed into the weekly or daily returns of VFV. To see this in a more fluid way, look at the rolling returns. This annualized 3-year rolling return highlights how varied it would be based on the timing of the investment. From a low of about 10% to a high of 18% annually. 5-year rolling returns are just as varied despite the smaller time frame to play with. In the ETF facts, we can see the best and worst 3-month returns over the last 10 years. The best was 15.9% ending in June 2020, and the worst was negative 13.7% ending June 2022. You can start to get a sense of the volatility of a medium risk fund with these performance numbers. In the management discussion of fund performance, they make a direct comparison to the S&P 500 index, which is the benchmark of VFV. Interestingly, I learned something new here. Did you know VFV used to track the S&P 500 index NY rate CAD until the end of November 2016? I sure didn't. Then it tracked the vanilla US version. So the data uses this splice index and the regular one. VFV is trailing the index 9 bips over the last 10 years. Remember, this fund has a 0.09 MER. Even at 1 year, you see the performance is off by just 11 bips. This makes sense considering the fund has approximately a 0.22% tracking error over the last 36 months. Remember, guys, this is all backwards-looking data during a historic bull run. This is not to be taken as what is expected for future returns. Those expectations look more like this according to Vanguard. The expected returns are a fraction of what we have seen with a large cap fund like VFV. However, these are just forecasts. They will change just as the market changes, just like a weather forecast would too. To add some color to this performance, let's look at VFV's Morningstar factor profile. As we should expect, it is overweight, large size, and quality. That's exactly what the index has been screening for. What surprised me was the lower liquidity and volatility. It's easy to get blinded by those massive gains, but what about the distributions hitting your account? This is where many Canadians get confused because VFV's 1% yield hides a potential tax trap that many overlook. Look back again at that annual total return chart. Do you see the column income return NAV? That's what percent of the total return was from the quarterly distributions. You'll notice over the years, the return has been mainly from capital returns. This makes VFV fairly tax efficient in all accounts. This is what the annual distributions look like over the last 13 years. The distribution is mainly made up of foreign income from the US, and sometimes a small capital gain or return of capital. Its first complete year had 49.3 cents paid, and in 2025 it was $1.52.8. That's a growth of 210%. That's phenomenal dividend growth by those underlying companies. Now, because VFV is a Canadian-listed ETF via US-listed ETF, there is a foreign withholding tax of 15% on the foreign income on any account you hold it in. That is not paid directly by you, though. It is paid by the ETF before you are paid the distribution. So that total distribution is what is actually deposited into your account. There are some caveats to this. Holding VFV in a taxable account, you could claim back that withholding tax you pay. However, in an RRSP or TFSA, it is lost and cannot be claimed back. However, if you want to optimize accounts, holding the US-listed version of VFV, VOO, will not have withholding tax in your RRSP. This will save you about 0.15% annually at its current distribution rate. To buy VOO will require you to either pay the hefty 1 to 2% CAD to USD currency conversion fees by your brokerage, or you can use something called Norbert's Gambit. It's a cost-effective way to convert CAD to USD or vice versa. Discount brokerages like Wealthsimple now allow for this with the journaling of shares. This used to be done only at the big brokerages in Canada. So we know it's amazing performance, and we know how to handle the taxes of the distributions. But are you buying in at the top? To answer that, we have to look at the price to earnings ratio. And frankly, the current number is sitting at a level that should give every investor a reason for pause. Quick thing, guys, before we continue. My goal here is to help out fellow DIY investors. If you think I'm doing a good job, smash that like button. This helps me know that this is the kind of content you want me to keep making. Also, let me know in the comments below what else you'd like to see. Thank you for all the support. Now back to the video. Quick thing. The current price to earnings or PE ratio of VFE gives us a sense of its current value. It is sitting very high at 21.6. I say that in comparison to its historical levels. For the majority of time, it has been below this level. As we talked about with past performance, we don't know what the future will be. But a high valuation is only scary if you don't know what you actually own. When you buy VFE, you aren't just buying the market. You are becoming a partial owner of a very specific group of trillion-dollar giants. Let's see who is actually driving this bus. VFE holds 504 stocks indirectly. It does so by holding the U.S. domiciled fund, VOO, that directly holds the underlying stocks. That is the principal investment strategy and is known as a physical full replication ETF. The reason there are more than 500 stocks in the index is because some of the companies have dual class shares like Google and Berkshire Hathaway. The top 10 underlying holdings are exactly the same as the index, making up 37.9% of the fund. Its top holding is the biggest company in the world, Nvidia. And all the companies in the top 10 are trillion-dollar companies or more, with exception to JP Morgan Chase. The S&P 500 has a similar concentration to the NASDAQ 100, with the top 10 of each fund the same, with exception to Berkshire Hathaway and JPM being replaced by Walmart and Micron. This is a market cap weighted ETF, so the bottom 10 make up 0.095%. And the bottom 265 companies make up just 10% of the fund. This is something to keep in mind with MCAP indices. You likely also noticed that the top 10 is made up of mainly tech stocks. This brings us to the sector exposure of VFE. This is what it currently looks like. Tech makes up 32.9%. Financials are next at 12.6%, and communications round out the top three at 10.3%. Materials is barely over 2%, and real estate is the smallest sector at under 2%. Now let's look at the geographical exposure. Do you know what that is? VFE is 100% US exposure. But don't let that fool you into thinking this is a simple large cap fund. When we look at the Morningstar style box, we see a mix of growth and value that might surprise those who think VFE is just a big tech play. It is known as a large cap fund. However, its fund style is technically a blended large cap fund, with 37% of the fund large cap blended, 23% in large cap value, and 21% in large cap growth. It has about 19% exposure to mid caps by Morningstar's definition. Looking at the Morningstar MCAP breakdown, you see the giant caps are 45%. That's the top 40% of the index. Large caps are next at 35%. That's the next 30% of the fund. And mid caps are at 18%. That's the next 20% of the fund. And this is the breakdown of VFE by Vanguard. Large caps make up 75%, medium to large 6%, medium 14%, and medium small 4%, and about 1% small. Here are the smallest companies in the index by market cap. The smallest has been in the index forever and was by no means ever that small. All of this looks great while the market is going up, but could you actually stomach the downside? Vanguard calls this medium risk. But if we look at the actual crashes this index has survived, you might find that medium feels a lot more like a roller coaster. Let's move to the risk profile of VFV. Now's the time to see if this fund aligns with your risk profile. We don't want to get caught focusing on just past performance. This is a medium risk fund, which means a standard deviation of between 12 and less than 16 over the last 10 years. Here's the S&P 500 index standard deviation. It was 15% over 10 years, 15.3 over the last 5, and 12.1 over the last 3 years. It has been trending less volatile with the bigger returns. Vanguard's data for VFV has a 3-year standard deviation at 11.15, with a higher Sharpe ratio of 1.27. This has to do with the US dollar strengthening compared to CAD. Remember, this fund is not hedged. VFV has had some major drawdowns in its short history, as we saw with its worst and best 3-month returns over the last 10 years. Using Portfolio Visualizer, I can see the recent drawdowns at month end. There have been 4 drawdowns of 10% or more in the last 7 years, the worst at 18.6%. This slide here that you're looking at gives some perspective on the recovery times of those drawdowns. Again, this is month-end data and not looking back many decades, just since 2016. For the index, there have been some major crashes over the decades. Here are 3 of the largest drawdowns in our modern history. The 2000 crash was bad, so bad, but just 7 years later came on one that was even worse. This can happen again tomorrow. So please don't think these things can't happen again. For more risk data, here's Morningstar's portfolio risk score. Morningstar rates this as an aggressive fund at 74. Very aggressive would be 79 for context. It has an average risk and above average return compared to its category. Again, that makes sense since most funds do not outperform the S&P 500 index. Here are some other risk factors that the prospectus highlights that I think are worthy of mentioning. VFV is 100% in US stocks, so there is a country risk. It is also not hedged, as mentioned, so there is a currency risk. If the CAD appreciates to the USD, the return will compress, and the opposite is also true, mind you. This is a M-cap weighted fund that comes with its own risk compared to an equally weighted fund. Before we wrap up this video, I think we benefit from understanding what exactly is the S&P 500 index. Now, you might think the S&P 500 is just the 500 biggest companies, but there is a hidden human element to this index that many people miss. Understanding this methodology is the secret to knowing why 96% of professional money managers fail to beat it. What is the index? The S&P 500 index covers approximately 80% of the free float adjusted market capitalization in the US. It's rebalanced quarterly in March, June, September, and December. This means that VFV is following a passive index. The management isn't making any decisions here as to what stocks to hold and at what weighting. However, the S&P 500 index, despite being classified as passive, does have a very specific criteria for inclusion with their index methodology construction. For this reason, some investors may say the S&P 500 index isn't completely passive. Some of the criteria are the stocks have to be US-based, the companies must have had positive earnings for the current quarter plus the 4 most recent quarters summed all together. It can be in any of the 11 sectors, which means including REITs, but it cannot include CEFs, other ETFs, ADRs, or other types of investments. Also, the index has market cap guidelines. This changes year to year. It's currently at $22.7 billion. All things considered, the S&P 500 index has a low portfolio turnover rate of about 4% last year, which explains why VFV had 0% trading expenses and has stayed that way for many years. As an index, the S&P 500 is considered the most important in the world. It represents 54% of the global stock market capitalization. Is that not impressive? 500 companies in the US make up that much of the world market. It is also really hard to beat over long periods of time. Just look at the SPIVA after-tax scorecard. 96.77% of actively managed funds underperform the index over 20 years. This report is done by S&P, so there is a conflict of interest in the report that I have to note. In any case, that's why so many people compare their portfolio to the S&P 500, even when their portfolio is nothing like it. And many people also refer to the S&P 500 index as the stock market. And that is also why some investors, even super investors like Warren Buffett, say this is the only index you need to own. This adds to the belief that this is a must-own index. Let's review. VFV tracks the S&P 500 index with 504 stocks. It costs 0.09%. It is listed in CAD and is not currency hedged. Who is this fund designed for? It is made as a core long-term growth holding according to Vanguard. The S&P 500 represents, as mentioned, 80% of the market cap of the US market. So it can be used as a proxy for the entire market without purchasing a total market fund like VUN. After this deep dive, here's my take. VFV is good for long-term investors. It's appropriate for passive index investors who don't want complexity in their portfolio or decisions to make day to day. It's great as a single ETF to track the US market and want direct exposure to the underlying holdings of the S&P 500. VFV is also good as a core holding to build a portfolio off of and combine with other ETFs for diversification, or even single stocks. And in my opinion, VFV isn't for you if you don't want indirect exposure to the S&P 500 index. If you are sensitive to big currency fluctuations or high volatility like we've seen. It isn't for you if you don't like MCAP indices or are uncomfortable with the concentration being in the top 10. And an index in general definitely isn't for you if you're looking to beat it. That kind of defeats the purpose. So what did you think of my full breakdown of VFV, the largest ETF in Canada? There are so many great ETFs in Canada and the US. I've made recent deep dives on all-in-ones, developed and emerging markets. Check out my playlist right here. Thank you so much for watching, guys.